Hey everyone, and welcome to this explainer. Today, we're diving straight into a massive mechanical institutional heist, something known as the liquidity trap. Look, if you've ever watched your stop loss get surgically removed right before the market turns and moves exactly in the direction you originally predicted, well, you're not experiencing bad luck. Today, we are going to completely shift your paradigm on market mechanics and show you exactly what is happening behind the curtain.
Right off the bat, let's flip the script on everything you've ever learned from textbook technical analysis. You are not trading price. Price is just the vehicle. What you are actually trading is liquidity. And honestly, until you internalize this massive inversion of perspective, every single technical analysis tool you use is just going to give you inconsistent results. The market is constantly hunting, and what it's hunting for is liquidity.
So you might be wondering, why exactly does your stop loss get sniped right before the market moves your way? Well, to figure that out, we have to ask why this trap is being set before your fingers even touch the keyboard. It all comes down to how real, actual markets absorb massive orders. Think about it. If an institution needs to execute a massive order, let's say a $200 million position in the Forex market, they absolutely cannot just click buy.
To fill that, they need a massive amount of sellers on the other side to avoid crazy slippage. That right there makes the real market a totally adversarial machine. Textbooks love to draw markets as these clean, symmetrical, perfectly cooperative things. But the reality? The actual mechanism of price delivery requires absorbing large orders, which means the market literally has to hunt for aggregated stop losses to fill those institutional orders.
So, here's our game plan today to unmask the real culprit behind your stop-outs. We're covering the retail trap, the anatomy of a sweep, mapping the trap, the sweep confirmation sequence, and finally, the institutional entry architecture.
All right, let's jump into part one, the retail trap. Let's unmask this heist.
To really grasp how this heist works, you just have to look at the most obvious support levels. You know the ones, you draw a clean, perfect horizontal line connecting a couple of swing lows. Looks great, right? Wrong. You're basically stepping on a landmine. You have to remember that every single stop loss is a pending order. When thousands of retail traders use that exact same obvious support line and tuck their stop loss right underneath it, they are serving up a massive liquidity pool on a silver platter. That dense cluster of pending sell orders is just a flashing neon sign for institutions who are desperate for liquidity to fill their buy orders.
And the psychological irony here is just brilliant. You actually have three completely distinct trader personas feeding into this exact same liquidity pool. You've got the cautious traders tightening their stops to protect unrealized gains. You've got the late buyers jumping in with FOMO, slapping their stops below support. And then you've got breakout traders waiting to aggressively short right below that same line. Three totally different strategies, all placing their orders in the exact same spot. It creates the ultimate perfect target.
Moving right along to part two, the anatomy of a sweep. We're going to look at the mathematical fingerprints here. See, a liquidity hunt isn't just some random chaotic wick on a chart. It leaves behind distinct mathematical fingerprints that we can actually measure. A true liquidity hunt always has four identifiable components. First, there has to be an obvious structural level. Second, we look at the velocity of the sweep. Third is the wick-to-body ratio. And fourth is the return to displacement. Let me be super clear on this. Missing even one of these components degrades your setup significantly. We aren't guessing here, we measure.
Let's break down velocity. For a proper sweep, the candle's body and wick must measure abnormally large and exceptionally fast. Specifically, we're talking about exceeding 1.5 times the 5-period average true range, or ATR. It doesn't just slowly, casually grind down into the level, it violently accelerates to snatch up that liquidity.
Once that level gets hit, we need to see rejection. The wick that penetrates the level needs to be about 1.6 to 2.2 times the length of the candle's body. That specific, measurable ratio is your visual confirmation that smart money just absorbed the liquidity. Right after that, we need to see 2 to 3 displacement candles aggressively closing away from that level. That confirms a genuine, fundamental shift in order flow.
Now, how you react when this happens changes everything. The moment price sweeps a level, retail traders almost always panic exit at the absolute worst possible price, or they just sit there paralyzed. But traders who are aware of institutional mechanics, they know this isn't a disaster. They're not panicking, they're pulling out their checklist. Because for them, this sweep is literally the starting gun.
Okay, part three, mapping the trap. This is our phase one identification.
So before the trap is even sprung, your job is to map out these liquidity zones pre-market on a higher time frame. And keep in mind,
institutions are far too big to execute at a single tick, so you have to define liquidity as a zone, not just a thin line. A good rule of thumb is calculating the obvious level, plus or minus 0.15 times the daily ATR. Oh, and it's super important to note which pool was taken last, because the markets rhythmically alternate back and forth between sweeping buy-side and sell-side pools.
That brings us to part 4, the sweep confirmation sequence. Let's validate that reversal. Once price actually enters your pre-marked zone, you just go into observation mode. You have to strictly observe these 4 steps to be completely sure the liquidity was absorbed. Penetration with velocity, a wick rejection close, a displacement candle, and finally, the formation of a fair value gap. If this sequence doesn't play out perfectly, walk away, because you might just be staring down the barrel of a massive, extremely dangerous breakout.
Let's look closer at step 2, the rejection close. The wick that pierces your zone has to make up at least 60% of the total candle range. If the body of the candle closes heavily outside your zone, the market is accepting that new, lower price. But a 60% wick, that shows aggressive, immediate rejection.
And for step 3, your displacement candle needs some serious meat on its bones. We want a body that represents 65% or more of its total range, closing aggressively in the reversal direction. This is your undeniable visual proof that the order flow is completely flipped.
Which brings us to step 4, the fair value gap. This is a 3-candle pattern where the middle candle's range doesn't overlap at all with the preceding or following candle. Actually, it's more than just a gap. It leaves a literal imbalance in price delivery. It represents a market inefficiency. Seeing this elevates your confirmation to an institutional grade, simply because price will very frequently return right back to this spot to fill that gap.
Finally, part 5, institutional entry architecture. Time to execute the heist. Look, understanding all of this is completely useless if you go and execute your trade with sloppy retail precision. So here is the strict trigger. You place a limit order, never ever a market order, at exactly the 50% midpoint of that fair value gap we just found. Why 50%? Because mathematically, it's the statistical mean of the imbalance. And again, no market orders here. Rapid spread widening can absolutely wreck your risk-reward before the trade even officially begins.
Next up is your stop-loss architecture. Don't just stick it right under the vulnerable swing low like everybody else does. Instead, place your stop 0.75 times the 10-period ATR below the sweep wick. It's a brilliant little formula. It lets your trade breathe with genuine day-to-day market volatility, and it tucks your stops safely outside the zone of any potential secondary resweep.
So we've nailed down the entry and the stop, but calculating the exact target requires understanding this entire mechanical flow we just talked about. When you structure it this way, these final target calculations unlock crazy risk-reward ratios that retail strategies frankly just cannot structurally achieve. Which leaves us with one critical final realization.
As we wrap up this explainer, I really want you to internalize these mathematical fingerprints. It's time to stop automatically donating your hard-earned capital to these liquidity pools. Ask yourself this final provocative question before you execute your very next trade. Are you actually trading the market, or are you just the liquidity the market is trading? Keep your eyes open, map your zones, and start trading the trap.